Alright guys, welcome back. So today I'm going to be doing COMM 217 Chapter 7, Reporting and Interpreting Long-Lived Assets. So let's look at the legend first. So anything in yellow already is chapter title. Anything in blue highlighted is our heading. Anything in green is our subheading. So let's look at the main points for our chapter today. So 1, define, classify, and explain the nature of long-lived assets. So let me highlight that. And interpret the fixed asset turnover ratio. So these are the two main things for number 1. Number 2, we want to look at apply the cost principle to measure the acquisition and maintenance of property, plant, and equipment. So number 2, we're just focusing on PPE. 3, apply various depreciation methods as assets are held and used over time. So number 3 is just looking at depreciation on assets. Number 4, apply measurement and reporting concepts of natural resources, intangible assets, and goodwill. So it's just reporting the measurements of these 3 things, which I'll explain. And then 5, explain the impact on cash flows of the acquisition, use, and disposal of long-lived assets. The impact on the cash flow from the acquisition, the use, and disposal of long-lived assets. So here is just our chapter breakdown. So acquisition, maintenance, and property, plant, equipment. So right here, if you guys can see. Here next, we just use the use, impairment, and disposal of property, plant, and equipment, natural resources, intangible assets, and goodwill, which I'll explain throughout everything. So number 1, acquisition and maintenance of property, plant, and equipment. So classification of long-lived assets. So what are long-lived assets? It's the term to identify property, plant, and equipment, intangible assets, goodwill, rental to others, administrative purposes, development, construction, maintenance, and repair of other assets. So it's pretty much all of that. And so they're listed as a non-current asset, which includes tangible assets, intangible assets, and goodwill. So tangible assets, these can be touched because they have physical substance. So let me highlight that in yellow. Physical substance. There are 3 kinds of tangible assets held for use and operations. You have land. I'll put that in yellow as well. Land never depreciates. You have building, fixtures, and equipment. And then you have your natural resources. So these are all 3 different types of tangible assets. Since we can touch them, we can touch our land, we could touch the building that we work in, we could touch the equipment, and we could touch the natural resources such as your minerals, the oils, and the food that happens in the company. Intangible assets has no physical substance, also known as intellectual property. So an example of intangible asset could be copyrights, patents, licenses, trademarks, software, and subscriptions. So they have no physical substance. So goodwill has no physical substance. It is the reputation that a company has with its customers. So I'll put that in green. Reputation with its customers. So an example of goodwill is customer confidence, reputation for good service and quality products. So many companies are, like, let's say Costco, are known for their good service and their quality products. And they have a goodwill with their customers. So let's look at the fixed asset turnover ratio. And this is an important, I think, the only ratio in this chapter. So what is its purpose? Well, we want to measure how effectively is management utilizing its property, plant, and equipment to generate revenues. So let me highlight that. How effectively are we utilizing our property, plant, and equipment to generate revenues? So the fixed asset turnover ratio measures the sales dollars generated by each dollar of fixed asset used. So that's pretty much just re-explaining its purpose just in simpler terms. So here is our actual ratio. So in green, you could see right here, I'll highlight it in case. So our fixed asset turnover ratio is equal to net sales, or our operating revenues, divided by the average net fixed assets. And as you can see on the bottom right here, our average net fixed assets is equal to the beginning plus the ending balances of property, plant, and equipment, which has to take into account the net of accumulated depreciation. And we all want to divide that by 2 since we're averaging it. So Low or declining fixed turnover ratio, it means that the company is expanding. So let me highlight that in purple. So low means the company is expanding. Increasing means that the company is cutting back on capital expenditures, anticipates a downturn. So cut back on capital expenditures. So here we have our short quiz. So this is new. So after every chapter or every like number, so one we're doing right now, I'm gonna be giving you guys a short quiz just so you could test how knowledgeable you are of the actual things, and it can also prepare you for the exams, which includes a lot of multiple choices. So number one, what is the term used to identify property, plant, and equipment, intangible assets, goodwill, and other assets used for administrative purposes, development, construction, maintenance, and repair? So here you have A, short-lived assets, B, non-essential assets, C, long-lived assets, and D, current assets. So our answer is C, long-lived assets. So I'll highlight that, no color. So which of the following is not considered a category of tangible assets held for use in operations? So as we said, in tangible assets, so we have land, B, building, fixtures and equipment, natural resources, intellectual property. So we have D, intellectual property, because intellectual property is something we cannot touch. Tangible assets is something we can touch. So land we could touch, buildings we could touch, natural resources we could touch. 3, what is a distinguishing characteristic of intangible assets? They are always physical in nature. They include land and buildings. They have physical substances. They lack physical substances. So like the opposite of tangible assets, they lack physical substance. We cannot touch them. So intellectual property from our number 2, this would be an example of an intangible asset. What does goodwill refer to in the context of long-lived assets? A, the reputation that a company has with its customers, the physical assets of a company, C, a financial investment in other companies, or D, the company's net income. So the answer is A. So I'll highlight that as well. Boom. So what question does the fixed asset turnover ratio answer? How effectively is management utilizing its current assets? How effectively is management utilizing its long-term debt? How effectively is management utilizing its property, plant, and equipment to generate revenue? How effectively is management utilizing its cash reserves? And so the answer is C, our long-term assets. So I believe it's right here. Yeah. So utilizing its property, plant, and equipment. So anything highlighted in pink right there. So number 6, how is fixed asset turnover ratio calculated? So this is the ratio that we just saw on top. So A, fixed asset ratio is equal to net income divided by total assets, net sales divided by average net fixed assets, total liabilities divided by average net equity, or total assets divided by net sales. So if we look, it's B. So here you have your average net fixed assets. And you can see, because in the example we saw above, we want to look at the average, and the average is beginning plus the ending of property, plant, and equipment. So number 7, our last question, what does a declining fixed asset turnover ratio typically indicate? The company is expanding. B, the company is becoming more efficient. C, the company is generating more revenues for each dollar of fixed assets. And the company may be experiencing issues and anticipates a downturn. So if it's a declining, it means it's expanding. And you can see that from right here in pink, or sorry, purple. So number 2, measuring and recording acquisition cost. So what is cost principle? It's all costs incurred in acquiring a long-lived assets, placing and preparing it should be recorded in the assets account. So it's all the costs incurred in acquiring a long-lived assets, and then placing and preparing is also recorded in the assets account. So we may think of placing an order or preparing an order as an expense, but in the cost principle, we actually record it as an asset and include it. So costs such as non-refundable taxes, legal fees, transportation costs, and installation costs are added to the price of the asset. They are not expenses. The expenditures, which we call, are capitalized. So let me highlight that in purple, meaning they are part of the total cost of the asset and not as expensive. So capitalized means that we are adding any cost to the cost of the asset. So I'll put this, the total cost of the asset. And they are not expensive. So capitalized, make sure you realize that they are not expenses. They are added to the total cost of the asset. An example of this is if a company purchases land, all of the additional fees of the purchase should be included in its cost and be capitalized in its cost. So acquisition cost, it's the total amount of money paid for the asset. So that's just what we say. So total amount of money is our acquisition cost. So various acquisition methods. So for cash, a company may pay with cash that was generated from operations or recently borrowed. For debt, instead of signing a note payable, another option is to utilize arrangements that include leasing assets. Leases that exceed over 1 year in duration are classified as finance leases or operating leases. So I'll put that in yellow. Operating leases or finance leases exceed 1 year. Leases are reported on the statement of financial position as right of use assets. So I'll put that in blue. Leases are considered an intangible asset and are not included in PPE. So leases are intangible. We cannot really physically touch a lease. It's more of an agreement. So for equity, a company's common shares, let me just change that. Should be a company. A company's common shares to purchase the company's goods or services at a special price. By construction, so a company may construct an asset instead of buying it. The cost of constructing the asset will include all direct and indirect costs, including the interest to construct. So capitalized interest is the amount of interest that is included in the cost of construction. When construction is completed, any interest and loans must be expensed. So let me highlight that. I'll put it in green. Yeah, I'll put in green. So when construction is completed, any interest and loans must be expensed. As a basket purchase of assets, so when several long-lived assets are acquired in a single transaction, so that's important, in a single transaction, the cost of each asset must be measured and recorded separately. Cost is measured separately. So the example we have here, so assume FedEx paid $3 million cash to purchase a build and the land in one purchase. So this should say building. So just in case that confuses anyone. So a building and land in one purchase. Total appraisal totaled 3,150,000. Indicated market values is 1.89 million for the building and 1.26 for the land. So the total purchase price is then calculated as follows. So note, total appraisal is equal to valuation from a professional. So what that's pretty much means it's not the actual thing. It's just a professional that says, hey, this is what our appraisal, the valuation of what your purchase is actually valued at. And total market value is the valuation based on market conditions, based on what it is in the market right now. So what we try to find is the total price. So I'll put that. So the total purchase price. So to do this, step one, we want to calculate our building market value divided by our total market value. So our market value of our building is 1.89. So you could see it right here. And then our total market value is 3.15 that we could find from right here. So our ratio or just the percentage is 0.6 or 60%. Then step two, we want to calculate your land market value and total market divided by total market value. So the market value of our land is 1.26, sorry. And then divided by the total market value from 3.15 million. So that equals to 0.4 or 40%. And then step three, multiply the ratio of the market value to the total cost. So since we paid 3 million and our building market value divided by our total market value ratio was 0.60, we just do 0.60 times what we paid, so 1.8 million. And then we do the same thing with our land. So we calculated 0.4 and we paid 3 million. So 0.4 times 3 million is equal to 1.2 million. So we paid 1.8 million for the building and then 1.2 million for the land. So repairs, maintenance, and improvements. So assets require expenditures to maintain or enhance their productivity. So companies may do things to repair an asset or anything like that. So expenditure, it's the payment of money acquired to acquire goods or services. Expenditures are classified as follows. One, ordinary repairs and maintenance. So expenditures that maintain the productivity capacity of the asset only in the current accounting period. So this is really important. So only in the current, so only like the 1 year accounting period. These are recorded as expenses. So if we do something and it's only in the current accounting period, so let's say something that's just gonna last like the 1 year, that's recorded as an expense. They are recurring in nature, involve relatively small amounts at each occurrence, and do not directly lengthen the life of the asset. So this is important. Do not lengthen the life of the asset. So let's just say it's a tiny repair of, let's say we fix the door, and it would be a relatively small amount, and it doesn't really direct the useful life of the asset. It's just fixing something and repairing it. So improvements is expenditures that increase the productive life, operating efficiency, or capacity of the asset. So I'll put that in orange. Increase the productive life of the asset. So capital expenditures provide the benefits to the company over many accounting periods. So unlike the number one we saw before, this goes through many accounting periods. These are recorded in assets. They are capitalized. And then they occur infrequently, involve large amounts of money, and increase an asset's economic usefulness in the future. So internal controls, they establish safeguards for the asset, includes purchase date, serial number, acquisition date, and cost. So just controls to make sure that the flow of the asset is properly managed and we can see anything that happens to it. So here are a short quiz. So indicate whether each of the following expenditures should be expensed in the current period or capitalized as part of the cost of the asset. So if you guys want to do it yourself, just pause the video right now and just do it. And then in 2 seconds, I'll unhighlight and you can see the answers. So a major replacement of electrical wiring throughout the building. So is this a capital expenditure or an expense? It would be capitalized. So since it says major replacement of electrical wiring, since major replacement kind of means right here involves large amounts of money and increases an asset's economic usefulness, electrical wiring makes the building more useful in the future. So it's capitalized. B, repairs to the front door of the building. This would be an expense, like I said before. You're just a single repair and it's nothing that's going to benefit the asset. So C, annual cleaning of the filters on the building's air conditioning system. This is an expense. So we could see it's an expense because they're reoccurring. It has nothing too large in the thing, so we're just cleaning it, and does not directly lengthen the useful life of the asset. All we're doing is just cleaning the filters. Like with anything, filters need to be cleaned every year. So let me just get rid of that. So these significant repairs due to damage from unusual floods, this would be capitalized. And once again, you could see significant repairs gives it away, and then damage from unusual floods. So the floods may have caused some damage to the asset, or repairs are increasing the usefulness of the asset in the future. So that means it is capitalized. So 3, use, impairment, and disposal of property, plant, and equipment. So depreciation concept. So all long-lived assets have limited life. Companies acquire assets expecting to produce future benefits, and a portion of an asset's acquisition cost must be purchased as an expense. So I'll put that in blue. In which revenue is received because of its use. So an example of this is FedEx earns revenue when it provides air cargo transportation services and incurs an expense when using its aircraft to generate the revenue. So depreciation is a cost allocation concept. Cost allocation concept means that the process of allocating the acquisition cost of buildings and equipment over the period in which the asset is expected to generate revenue. Net book value is equal to the acquisition cost minus accumulated depreciation. So just remember that. Accumulated depreciation is depreciation expense accumulated since the acquisition date is a contra asset. The cost of a long-lived asset is recorded at its current market value only at the acquisition date. So depreciation expense is the amount of depreciation recorded during each period that is reported on the statement of earnings. So if you guys do some examples, you'll see that accumulated depreciation is reported on the asset account since it's a contra asset account. Depreciation expense is reported on your expense account. So calculating depreciation expense. So depreciation expense requires three amounts. You have your acquisition cost. You have the two estimated useful life of the company, so in months or years, and the estimated residual value at the end of the asset's useful life to the company. So just remember these three things. Usually they'll be given, or you might have to calculate one or two of them. So estimated useful life is the asset's useful life to the company, not to the users. Sometimes in the question, they may give you the useful life, let's say 30 years for a building, 50 years for land, or something like that. Estimated residual value or salvage value is the estimate of the amount the company expects to recover upon disposal of the asset at the end of its estimated useful life with an estimated cost to dispose it. So the salvage value, so the estimate cost to dispose it. And for useful life here on top, I'll do, there you go, I'll highlight that. So alternative depreciation methods. So we will discuss the three most common depreciation methods. Straight line method, when an asset's usage is the same period. We have units of production and declining balance as well. So these are the three methods. So I'll talk about straight line method when an asset's usage rate is the same each period. So straight line formula, depreciation expense is equal to depreciable times the straight line rate. So this is here, but we could find what these two mean right here. So depreciable is equal to cost of acquisition minus residual value. So they'll give you the residual value, or you might have to calculate it. Straight line rate is just equal to 1 divided by your useful life. So your useful life right here, sometimes they'll be giving like 30 years, like I said. So 1 divided by 30. Units of production. So when an asset's usage varies each period dependent on activity or productivity during the period. So units of production formula, it's your depreciation expense is equal to the depreciation rate per unit times actual production. And we can find depreciation rate per unit by finding your cost minus residual value divided by your estimated total production. So they might give you in a question, oh, we expect to produce this much, and then we calculate that for the depreciation rate per unit. And then in the question, they might say, but our actual production was this. So then we use two different numbers from estimated production to actual production. So our last method, declining balance, is when an asset is more efficient in its early years of usage, producing more revenue but less efficient over time. So declining balance formula, depreciation expense is equal to carrying amount times declining balance rate. Carrying amount, we can calculate this by cost minus accumulated depreciation. And declining balance rate is 2 divided by your useful life. So just like our straight line formula, 1 divided by useful life, but in this one we use the 2 divided by useful life. So notice as accumulated depreciation increases each year, the carrying cost decreases. So here you just have a summary of everything. So I'll surround that in my highlighter. So your method, you have your straight line. I'll put this in green. So straight line, your computation is just cost minus residual value times 1 divided by useful life. Units of production, cost minus residual value divided by estimated total production times annual production. And then double declining balance, your cost minus the accumulated depreciation times 2 divided by useful life. So for acquisition and amortization of intangible assets. So intangible assets has no material or physical substance, like I've mentioned in number 1. Intangible asset is developed internally. The cost of a development is normally recorded as an asset, as an expense, sorry. So since it's developed internally, we want to record it as an expense. So definite life, the cost of an intangible with a definite life is allocated on a straight line basis. Amortization, used to periodically lower the book value of a loan or intangible asset over a set period of time. So this is important. So lower the book value of a loan or an intangible asset. Indefinite life is these assets must be reviewed at least annually for possible impairment of value that may be due to negative changes in technology. So consumer preferences and economic downturns, increases in cost, deterioration in the industry. So let's look at patents. So a patent is an exclusive right granted by the CIPOIC. This isn't too important to know, but it's just the abbreviation of who grants the patents, and patents last 20 years. So this is very important to know. A patent is granted to a person who invents a new product or discovers a new process. So granted to whoever invents a new product or a new process. A patent prevents a competitor from simply copying an innovation. So that's what it does. It prevents competitors. So copyrights, a copyright is the protection is also granted by the CIPO. It gives the owner the executive right to publish, use, and sell a literary, musical, or artistic piece of work. Copyrights last 50 years. I'll put that in orange. After the author's death. So you have your copyright, and then once the author's death of whoever wanted to claim the copyright, it'll last 50 years after that. And so many companies use copyrights to publish things such as books or anything like that. You might see, I believe copyright is the C. So it kind of looks like this. I'll try to do my best. A C with a circle around it. So technology is an intangible asset to modernize their processes for greater advances. An example of technology is computer software and web development costs. So research and development costs is if an intangible asset is developed internally, the cost of research is recorded as an expense. So like I said here on top, if something is developed internally, is recorded as an expense. An example of this is Pfizer spent $13.8 billion on research and development for the COVID-19 vaccine and must report it as an expense since it was an intangible asset that was developed internally. So trademarks. Trademark is the exclusive legal right to use a name, image, or slogan identified with a product or a company. Trademarks can be renewed after 15 years. Companies spend millions developing trademarks, but are not reported as expenses. But are reported as expenses. So example of this is a corporate logo such as Toyota, Tesla, RBC, Tim Hortons. Those are all trademarks towards their company or slogans that could be within every company. So franchises. A franchise is a contractual right to sell certain products or services, use certain trademarks, perform activities in a geographical region. A city may grant a company a franchise to distribute gas to homes for heating purposes. A company may sell a franchise for the right to create a local restaurant. Franchises are counted as intangible assets since they require prior investment. So an example of this is McDonald's franchises all over the world. They are a contractual right to sell certain products such as their Big Macs in local restaurants. So Yeah, so that's franchises. I'll just put a dent here. Licenses and operating rights. So licenses and operating rights permit the holders to use public property in performing their services. So licenses and operating rights can be regulated by the government. Example of this is operating rights for landing slots at many airports. So it's pretty much a permit. So goodwill. Goodwill is the favorable reputation that a company has with its customers. Goodwill arises from customers' confidence, reputation for a good service, quality products, and financial standings. Goodwill is internally generated and is not reported as an asset. Goodwill is internally generated, not reported as an asset. The only way to report goodwill as an asset is to purchase another business. So that was another type of goodwill. So purchase goodwill is the difference between the purchase price of a company and the fair value of its net assets. So I'll highlight that. And then goodwill, I'll highlight in the top, favorable reputation that a company has with its customers. So short quiz. So if you guys want to do it, just pause the video before I unhighlight the answer. So one, what is the distinguishing characteristic of an intangible asset? So you have all of these. Has no material or physical substance. It is always a physical asset. It cannot be touched and seen. It can be touched and seen. And D, it is always tangible. So it would be A. How is the cost of an intangible asset with a definite life typically allocated? So it is not allocated. It remains a lump sum expense. It is allocated on a straight line basis. It is allocated based on the company's profit. It is allocated based on the asset's market value. So it's B on the straight line basis. You can see up here, if I go back up, our straight line basis right here. So what is the purpose of amortization in the context of intangible assets? So A, to increase the book value of an asset. To B, to periodically lower the book value of a loan. C, to periodically lower the book value of an intangible asset. Or D, to increase the value of a goodwill. So it would be C, to periodically lower the book value of an intangible asset. 4. For intangible assets with indefinite lives, what must be done at least annually? A, they must be written off. They must be depreciated. They must be reviewed for possible impairment of value. They must be capitalized. So the answer is C. 5. What is the term for an exclusive right granted for 20 years to the inventor of a new product or process? So this would be either copyright, trademark, patent, franchise, and would be patent. And just remember, a patent can be a product or a process. So what is the primary purpose of a patent? To prevent competitors from entering the market, to restrict the use of a product or process, to grant an exclusive right to use a name, image, or slogan, to protect intellectual property. So the answer is B, to restrict the use of a product or process. So if we're the inventors of the product or process, we want to have the exclusive right to use that. So how long does copyright protection typically last after the author's death? 50 years, 25 years, 10 years, or copyright protection lasts indefinitely? The answer is A, 50 years. What is the term for an intangible asset that allows a company to modernize its processes for greater advances? So this would be technology. If an intangible asset is developed internally, how is the cost of research typically recorded? Recorded as an expense, recorded as an asset, reported as a goodwill, or ignored. It is ignored in financial statements. So intangible assets, if it's developed internally, is recorded as an expense. What is the term for the exclusive legal right to use a name, image, or slogan identified with a product or company? So copyright, technology, trademark, or D, patent, it would be a trademark. All right, so number 5, impact on cash flows on the acquisition, use, and disposal of long-lived assets. So the acquisition, sale, depreciation, and amortization of long-lived assets affect the company's cash flows as indicated in the following table. So operating activities, you have the effect on the cash flow. So your net earnings adjusted for, so depreciation and amortization expense, this would be an increase or positive effect on cash flows. Gains on disposal of long-lived assets would be a negative effect on cash flows. And losses on disposable of long-lived assets would be an increase effect on cash flows. Losses due to asset impairment write-downs is an increase. And investing activities such as purchase of long-lived assets is a decrease, and sale of long-lived assets is a increase. So buying and selling long-lived assets are investing activities. So let me highlight that in blue. Selling long-lived assets is not an operating activity. Gains on the sale of long-lived assets are included in the net earnings and deducted from operating activities to eliminate the effect of sale. So that's it. Thank you.